My guest today on the Alpha Exchange is Jess Stauth. She is the CIO for Systematic Equities at Fidelity Investments. Jess, it's a pleasure to welcome you to the Alpha Exchange.
Thank you so much, Dean. I'm really happy to be with you today.
Looking forward to the conversation, a chance to talk about your framework, your career history, and the process you and your team are using at Fidelity to risk manage exposures for your clients. Let's learn a little bit about your career history. I saw you have a PhD in biophysics, and after doing some postdoctoral work, you landed on Wall Street in May of 2008. Of course, months before the Lehman bankruptcy and an incredible vol event in markets. Tell us a little bit about how you got your career underway.
Yeah, it certainly, in hindsight, was interesting timing. And had I known at the time what was coming, I probably would have had maybe a little more trepidation. So I'm glad I didn't. But like you said, I started my first quant job in May of '08, and at that time, I was sort of thinking about going from basic science, like you talked about. I had sort of a basic science and kind of data science background into quant, and I knew a lot of folks who had made that transition. So it was common, certainly at that time. And as I was exploring and thinking about and prepping for either an MFE program or just trying to find a job in the quant industry, a lot of people were mentioning to me the flash crash quant crisis in August of '07. And so that was sort of my first exposure to, oh, interesting, I'm going to go join this quant field. And you kind of come in thinking, hey, people, can't perfectly predict risk or return, but they sort of have a handle on things. And the questions that folks had around what happened, for those of us who remember, in August of '07, there was a really strong dislocation in the markets that recovered really quickly, but kind of spooked folks, right? And felt like it was sort of a quant problem, at which we later, I think, found out, who knows, it was sort of a precursor to maybe some larger instability. But it was really an interesting entree for me into, actually, in this quant world, there's still a lot of unknowns, just like there had been in this sort of science world that I was coming from. So I found that a little bit nerve wracking, but also, interesting, intriguing, and really, I think, set the tone for what I have continued to find through my career, is that benefits you to be humble, and appreciate what you do not understand about how the market functions. So that was sort of May, right? Not knowing kind of what was to come in the fall. And I think the other interesting thing for me is, while I was starting to learn about equity stock selection, so I spent the first part of my career really focusing more on kind of bottoms up quant modeling, and really what you care about there, okay, is just like ranking stocks against each other, right? So you're not thinking that much as this equity stock selection quant about a macro environment or variables. You're sort of assuming that that's going to kind of raise and lower the tide, as it were, for the stock market, and you're caring a lot about these relative differences. But clearly, what became very clear coming into the end of that year is that those tidal waves or tsunamis of effects that are macro or are of a larger scale, they can really swamp those relative rankings. And so they're difficult to predict, but important to consider, how to think about what you're working on and how that's going to be impacted by really big, broad uncertainty in the market. The other thing that I think that helped me with in my career is, it was also kind of a quick reminder that, yeah, what matters for you when you're working on quant research is, the efficacy of your research, how you're thinking about the markets, but also what's the business model of the firm that you're working at. So at that time, the firm I had joined was called Starmine, and they were selling stock ranking models through both to fundamental investors and quants. They had just been acquired in May of '08, right around when I was joining, by the company that at that time was Thomson Reuters. Fine, so okay, big aggregator had bought a lot of companies. So when the financial crisis hit, we were not a little startup afloat in the sea, which I think would have been a really scary place to be, but we were attached to this larger business. And that larger business was a subscription based business. So I think when I looked back, I felt fortunate to have ended up in that spot at that time. It ended up being a bit of a safe harbor, but it has caused me to appreciate through my whole career that you want to be kind of focused on multiple levels of what the signal research or the investment research you're doing, but also thinking about where you fit into the business and where you fit in terms of your clients. At that time it was customers, and today it's investors. So that it's really important to have kind of that broader perspective. And I've tried to take that with me through my career. I think I'll skip over lots of fun stuff in the middle that we may or may not get back to, but I will say, sort of fast forwarding up through today, 2025, one thing that I find interesting is as we do research, we find it increasingly challenging to make sure that we're including enough history to cover those market cycles, right? So there's these really long cycles in which it's non-trivial to capture information about big, broad market shocks, and so that's something that I and my group spend a lot of time thinking about how to make sure that we're utilizing a lot of historical data, so that when we're improving the quality of our models, we're not just thinking about how things work in a bull market or an up market, up and to the right, Mag 7 dominated market. We're really trying to, think through and understand how strategies will work across lots of different types of market environments.
It's interesting. We're having this conversation on November 20th, and outside of the 83 print we had in the VIX during COVID, I think it was 80.8 on November 20th of 2008. So I always like to look back on, events of consequence, especially in terms of market disruption. It's interesting to me that you landed at that quant research firm basically halfway between the Quant Quake of '07 in August and the onset of the GFC. And you sort of alluded to it there, and maybe it's something I've thought a lot about as well, which is what are the linkages there? Because the Quant Quake, it really had nothing to do with derivatives. The VIX only got to 23 or so in August of '07. The S&P got it to an all-time high in October of '07. But it certainly feels to me that there are some commonalities there. I just was curious if you've given that any additional thinking about, where they're similar and, where they're kind of uniquely isolated.
I guess maybe there's two dimensions. I think make sure that the question that you're asking, but you're sort of saying, hey, zoom back to then, and was that a '07 incident, and then the subsequent much larger '08, or was there some precursor or relation or signaling? It's hard to it's hard to prove that there for sure was, but it's also hard to see that it as a pure coincidence, I guess, right? Because they sort of felt pretty linked, I think, for those of us who were in markets, or I was just starting to be in markets at the time. When we think about how quants thought about what happened in '07, there's been a lot of research and a lot of ongoing debate across the subsequent years about sort of what really happened, and a lot of theories advanced. Folks, listening may or may not know about that incident, but some of the theories that were advanced, and maybe one that's kind of a pet theory that certainly is intellectually satisfying, is that at that time there were a lot of similar types of quant strategies in the market, and there are common themes for the types of factors that quants tend to invest in. Right, they're looking at broad, persistent return drivers. Some of them are similar themes that fundamental investors will look at. Right, things like some technical components of momentum and mean reversion, valuation based measures, some fundamental driven measures, growth measures, quality measures, right? So okay, some common themes, and maybe there were a lot of quants who were using those themes similarly, but the real finger kind of got pointed not at necessarily the correlation of what those returns drivers were, but were a lot of quant firms, or enough of them that were concentrated enough, using similar risk modeling approaches. And those risk modeling approaches, this was something I did think, coming from a science background into finance. I will come back if we have time on this. I found it really took me a few years to really internalize what people meant by risk. By the way, because I was like, how do they know what the risk is? Like, how that feels like you're saying the future. And then I was like, well, wait, I think they just mean what has happened, but they sort of say it like it's what's gonna happen. And I thought I was missing something for years, right? I was like, they seem to know, right? And then I realized, well, no, we don't. All we have is the past, basically, right? So okay, got these risk models, and you're placing a lot of faith in them, right? maybe too much. And the thought was that some of those risk models were picking like a few things that looked kind of magically like they would hedge out a lot of risk out of your portfolio, because that looked really efficient to the optimizer, right? So the mathematical problem to say, what's the most efficient way to hedge my risk? And these models would find these kind of weird little corner case things that would look like, yeah, 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 good idea. So it's sort of like we're all buying the same little concentrated insurance policy, right? And then if we all need to cash in at once, like maybe got little small insurance providers like, whoa, 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 I didn't actually have, that amount of backing to be able to insure the whole market. And there was a thought that there was, perhaps sort of an unwind or a deleveraging that kind of went run away. Now that I think, the other thing is like, let's say that's true or not true. Certainly something was very jittery, right? And something triggered kind of a cascading feedback loop at that time. And I do think personally that kind of, super sensitivity is can be the problem is, right, not always, can be a bit of a warning sign. So I don't know if we took it that way at the time. Like I said, it did make people nervous. But I think what was interesting then, and maybe this is something to sort of continue to keep an eye on, is at that time there was this is a quants problem, right? So that was kind of coming up for me as an interview question. And I think by the time you get, a year, 2 years later, it wasn't people were talking about a quant problem anymore. They're talking about, market problems. So I think that also has kind of reinforced for me through my career that there can be a sort of false delineation between kind of quant and fundamental. But when you get down to it, right, the implementation approaches, the portfolio construction, the timescales, those can be different. But we're all trying to look at and understand markets based on data, and often fundamentally driven data. So, we will come up with similar approaches and be impacted by similar dynamics in the market. We're trying to find uncorrelated sources, but you know that's just the reality of the market, right? Big things happen. There's often, not a great way to completely stay out of the way of that.
I think in the aftermath of big drawdowns, it seems like this idea that, oh, we all had something very similar on tends to be pretty repeatable. And so I think you were alluding to it there with the Quant Quake, the overlap of exposures and really having to manage who's alongside you and how same your portfolio might look to someone else. And if that someone else becomes vulnerable, maybe it's a mark to market call or something like that, right? You're vulnerable because your competitor, becomes vulnerable, and you have overlapping exposures. It's a super interesting concept. Um, I wanted to sort of take it to the big picture of quant investing because it's such a wide category. And I know just enough to be dangerous, but you have the high frequency, extremely high frequency trading firms, and then you have more, perhaps fundamentally oriented quant. I think of FAMA French factor types like AQR and DFA and so forth. They feel a little bit more slow moving. I just maybe wanted to get this part of the conversation started with you giving us a little bit of the big picture of how you think about the different kind of components and then where your team would fit in.
Absolutely. And I think you're framing for quant world, the time scale of your investment horizon is probably like one of the more useful dimensions to sort of think about to categorize, what works over microseconds is not super relevant over weeks and months, and what works over weeks and months may or may not be relevant, over extremely long holding period. So I tend to think of, there's asset class, there's geography, and then there's time scale. So if you're talking about, sort of what my group does, really focusing on equities, then okay, that's your asset class. We look across a lot of different geographies, which is a very interesting way to slice and dice the world. We try to think about those geographies, normalize them out, and look for commonalities when we in the parts of our suite where we have international or global exposure. So, okay, let's go across geographies. Then it's timescales. So timescales are really interesting for the bulk of the products that I oversee. now these terms are thrown around mid-frequency quant. Okay, so but what I'll define that is, a typical strategy that we might run within my team will tend to say turnover around 100% a year. Okay, so we're caring about fundamentals. We're holding individual positions for weeks or potentially months. An alpha can look good and be in favor in the portfolio for a pretty long time. You can also have turnover within that portfolio where hopefully you're being dynamic. Positions are coming in and out. So like why that's relevant, again, I guess not to repeat myself, is your forecast horizon tells you a lot about what kinds of signals or data could potentially be relevant during that time period, right? So the shorter you go, the more that it's not going to matter. Let's say if you're going to hold a stock for a day, unless that day is earnings day, it may not matter what that firm's next quarterly reported earnings are, right? So if you're going to hold for a really short time, you start caring about less and less data that's not just market derived data, sort of price and volume derived data. Now, maybe one exception to that, just to touch on, because I do think they're fun, would be like event driven strategies. So there, you might care about fundamentals. You might just be getting in and out on the day of the event. So you then would care about fundamentals, though you're holding over a short time period. But as a general rule, the shorter the time period, you start to think of like really statistical derived factors. And then we get super, super short. And this was an area that was really getting big when I was coming into quant. A lot of smart people sort of felt like there was a little bit of brain drain toward that HFT corner and market making. To me, I thought, and it's kind of, I think, how it's played out that, again, if you're kind of a quant and you want to be thinking like, why are these stock prices moving? You tend to be thinking over more about the underlying companies. And I felt like where that HFT game was going, and I think it kind of did, is really high performance computing, right? So in the limit, you're getting down to, it's not really about companies, right? It's about electronic markets. Right. So, okay, fine. We can go down to that time scale. That's not where my team focuses or where I sort of have been interested for most of my career. So back in that longer time range, you get to look across a lot of different types of information, which is great. One challenge can be that you're trying to look across lots of different types of information that can have different forecast horizons. And then one area that's pretty interesting and area of active research for us is how do I combine information on different time scales? So if I have certain types of information that are likely going to matter over a shorter time range, how do I combine those with other types of information that are going to take longer to play out? And that sort of multi-period problem, we quant nerds call it, is something that people like working on and thinking about. And there's a lot of possibilities for differentiation in how you decide to combine signals together. And maybe just to complete on that thought, I will pull in the risk side of the equation a little bit. So we talked already a bunch about sort of the perils of using the same exact risk management techniques as all of your peers or competitors. And obviously, people were not kind of walking into that thinking that was necessarily what they were doing, but hindsight's 2020. So one thing that the research team I was on, like back in when the financial crisis happened, but also still the same kind of work that the team I oversee today does, is people really realize you probably want to customize how you're thinking about risk. So we are utilizing multiple risk models across most of the products that I oversee. And we think of that as a multi-layered approach that's hopefully going to catch where you may miss a sort of dynamic risk coming into play. So multi-layer, what do I mean by that? Well, one layer is this customized risk model that it knows about all the factors that I'm trying to get alpha exposure to. Okay, so that's beneficial because you'd like to get as much exposure to your returns drivers as possible, but you want to be aware of cross correlations between those so that you're not doubling or tripling up on certain features, and you're trying to make sure you're getting the right amount of risk that you're targeting, not more, and actually, interesting enough, not less. Okay. If you often overestimating your risk, which can happen if you have like a not well calibrated risk model, you're actually going to run below your target risk budget. And that can lead to underperformance. So you really do want a nice match between your return driver, sort of alpha model, and your risk model. So that is the first real important layer for us. And we view that as a differentiated part of the process. Then we find that it is important to also be looking at our risk with respect to other vendor provided risk models, but more than one. And one thing we like to do is look at both fundamental risk models and what are called statistical risk models. And so, not to get too nerdy, but you have maybe some real nerdy folks in your audience. I'm not sure. Okay, great. So PCA driven risk models, and there what you're looking at is, hey, I don't actually not going to write down what I think these risks are ahead of time. I'm just going to analyze the information and look at what is showing up as the biggest dimensions of risk. Now, sometimes you look at these statistical risk models and say, well, okay, great. You're picking up big directions of variance in the data, but I don't know what that thing is. So, what am I supposed to do about it? So, we find that that's not helpful to be the main or only lens to look at risk, but that it can be really helpful to have that tool in your toolbox because when those dynamics change, now maybe you want to go look really carefully, right? And say, hey, is there a new risk surfacing here that's being picked up statistically from the data that I wasn't looking for. And now can I go figure out, oh, interesting, right? There's some interest rate exposure or some political exposure or something. Or, right now we spend a lot of time talking about AI baskets, AI risks. What are those? How are we figuring those out? So that I guess the other thing I'd say is that risk management piece I have learned over my career is just as important, if not in some cases potentially more important than the alpha piece. I think I've seen across my career both just a lot of different opportunities to see that you can have good alpha ideas and they can get swamped by poor risk management. So we put risk management really as front and center for the strategies that we run within my team.
I found it really interesting what you said earlier, which was you got to Wall Street and you heard people talking about risk as if it was what was to come, and you finally realized this is really looking backwards. And I'd like to tie that into what you just said, which is around looking at your risk and trying to understand it. And of course, risk is two ways. It's either being over or under allocated to it. Both are risks. So you're either oversized or undersized. And so in some ways, we stare at the recency of performance, whether it's across a broad index like the S&P, and we measure its realized vol. We're always looking behind us when we do that. But we care, right? We care about what the market's telling us. What is that balance like in terms of utilizing historical data for risk measures and ultimately for some input into the sizing process? And what's that balance between taking it seriously but not taking it literally?
That is a big topic. So I guess one quick thing I'll say that I got a little more comfortable with what people meant by, well, risk is trailing vol. So one thing I thought was interesting, again, kind of early on, starting to figure out like, hey, what are, kind of translating, right? I really came from the science view into markets. And really, actually, I thought I'd be mostly interested in behavioral finance, by the way, and realized, yeah, yes, that's interesting, but it's sort of all behavioral finance, I guess. So the one thing I guess I would say is that I did come to appreciate that, volatility is a lot more persistent than a lot of other factors. So I guess I see why people rely on it a lot. It still has the problem of it's got a high autocorrelation up until when it doesn't, and when it doesn't is like exactly when you would have needed, some prediction of it. So I think the way that we in my team and I also would say like I guess me personally have thought about at the very simplest level, how can you balance that? Well, at least you try to balance it. So you say, look, I'm going to use historical information, right? I'm going to look at trailing vol. I'm going to look at trailing correlations. I'm going to look at how well or not various returns drivers have performed. I'm going to go ahead and use that information, right, in order to try to give my model the best advantage for having a good returns prediction or a good realized return. I'm going to do all that. But I'm going to set guardrails, right? So I'm sort of going to come in with, if you were a Bayesian, you could come in and say, well, those are my priors. You can do that. I like to think of it as, I might have designed the most sophisticated Roomba vacuum cleaner in the world, but I'm probably going to have a lot easier time if I set it up inside of a known fenced in area, right? So I don't want it, flying off my roof or right wherever. I don't want it going into an area that just from common sense says that's probably a good limit. So I have found that that's a really useful, simplifying principle to apply, because if you're coming in with some basic guardrails, and we have a pretty good advantage here because a lot of the strategies that my team oversees, they're pretty low risk managed anyways. Okay. So we're kind of targeting trying to take a couple hundred basis points tracking error from the benchmark. We're very benchmark aware. So that provides me with some nice guideposts. Okay. So I'm like already in what I would call a very safe, sane region. I'm not pushing it right to the edge. And then within that, I'm going to use that information that I've got to try to get the best advantage, but I've got a guardrail. And I think the nice thing about deciding and writing down what those risk guardrails, so those can be sector limits, right? Asset bounds, whatever might, be the right fit for your strategy. But intentionally using common sense to define those limits as opposed to fitting them from the data or making them dynamic, um, you're removing some degrees of freedom from your model. And so you're limiting your ability to overfit. So I would say that's like another common knock on quants. And I heard that many, many, many times through my career. How are you sure you're not overfitting? How are you sure you're not overfitting? It's a good criticism for quants, okay? Because it's a thing you certainly can do, right? You can kind of keep analyzing, keep running, doing multiple comparisons, using historical data, running tests. There's sort of like a joke if you're going out, earlier in my career at various times was working for, with, or adjacent to folks trying to raise money, right? And you go out and people say, well, no one's ever shown me a bad back test, right? Okay, fair enough. That is right. Why would you show someone a bad back test, right? So you have that kind of is like a core challenge to guard against in the quant world. And so if you're defining guardrails up front and not fitting them, you're removing parameters. You're basically lessening the risk that you're really going to overfit your models.
In doing some prep for our conversation, I saw some of what you guys had written on just, I'll call it the GME incident, where, markets just in January of 2021 take on just kind of a crazy, a craziness to it, right? And so you're sitting there with an investment process that you want to stay adhered to, and yet the market's just doing some really unbelievable, never say never things with GME and AMC and the meme stock episode. And so before we get into the factors, I just was wondering around the macro backdrop. You mentioned some of the PCA work that might pick up on things like interest rates. How do you either incorporate some of what's happening on the macro side to your advantage while not potentially getting stuck by being overly consumed by every last macro hiccup or data point?
I think that is a great place for humility for the quant and the quant modeler. Okay. Because the way I think about it is it's just people that build quant models, right? So we're a bunch of people using data and building a model. And that model is, there's a sort of saying of like, all models are wrong, but some are useful. And I think that is like the important thing to keep hold of is the market is not is not like the solar system. There are not laws of gravity, right? Things can change. And so when you're building a model to try to predict returns, you're trying to say, hey, what's generally been true? What's my best idea? What's the best data I have? But that model cannot know about like really weird unanticipated events like that retail traders are going to all pick some random stock and go decide to pump it and initiate a short squeeze. squeeze, right? So I've gotten to look at and study and think about short squeeze phenomenon. Before it was a meme stock situation, there have been short squeezes plenty of times throughout history. They tend to catch quants, okay? Because up until it's a short squeeze, and I don't know if we have short squeeze nerds in your audience as well, but they're really, really fascinating, right? Because right up until it's a short squeeze, it's a really great short. It's usually the case, right? And so these companies that get squeezed, you're looking through and saying, hey, what would be a company that people just think is going to go down, right? And sophisticated investors who are taking asymmetric risk all think a certain company is going to go down. Like they're probably right. And statistically, analyze all the data. That's generally true. Except once in a while, when they're holding a lot of shares short in something else. Now, lately, it could have been, a Reddit forum or something, but some other exogenous thing causes that to like not be true for a minute. Then, like you said, you basically get this, crowding effect of everybody's got to unwind. There's a margin call, there's forced deleveraging, and the thing goes through the roof. I remember in my first quant job, I had a manager that I worked with who would talk about how when he was at a hedge fund, he was short Volkswagen, and I don't know what year this would be. So some of you folks, that is before my time. And he was short Volkswagen, and there was a squeeze, and so someone gave him like a little Volkswagen car that he kept on his desk ever after to remind himself that you couldn't anticipate that. Okay, so that's like kind of the whole table setting. What do we do when that happens? So that's really where the magic of having human risk management in the loop and human portfolio managers as part of the team who oversee these strategies. So we have a research team that thinks a lot about how to build the model that should work during ideally normal market conditions, even if those are, moving around a bit. But then we have a team of portfolio managers who are sitting there with the portfolios all day, every day, keeping a careful monitoring eye. And when something happens that the model cannot know about, like a short squeeze is a great example, what we do in that case is we say, hey, we have an alpha forecast. That alpha forecast comes from a model that did not know that today there was going to be a Reddit post that said, hey guys, we should all go squeeze this stock. So, given that the model didn't know about that alpha forecast that I have, I suddenly have a lot less confidence in it because I know, right, that there's new information in the market. So, what can I do? In that case, we view that as my confidence level just went down. So, what do? I take risk off. It's actually really simple. It's kind of complicated to predict it up front, but actually once it occurs, it's, I think, pretty simple to know what you do. And it's sometimes hard to do it, right? Because at least if you're thinking sort of maybe from a retail trader mindset, I think it's hard to do it. It's hard to take a position off when you still have conviction. But that's the prudent risk management thing to do is your conviction is now on a different time scale. There's new information in the market. So that's where, that's one example. There are other types of examples like that where we will take risk off. Now, for us, we're most of the strategies we oversee, I'll generalize, are long only strategies, and they're targeting a beta of around 1. So for us, de-risking means going to a benchmark weight as opposed to, if a different type of quant strategy, you might basically be trying to completely get out of that position. We have a little bit of a better situation. If we're trying to close something, we're just going back to benchmark weight. Now that's going to not look like an active over or underweight for us.
So let's talk about the factor side of things. The classic fama French, DFA factors are things like value, momentum, quality, growth. But over time, and just given a lot of smart people chasing a lot of data, the factor zoo emerged, right? Where there's just 500 of these things. I just would love to start it off with how you think about factors, where you and how your team utilizes factors in the portfolio.
Yeah, absolutely. So, one thing that I think is important to keep in mind is some of these broad factor category families, I think is the kind of internal term we'll use when we talk about it. Yeah, they are known. And so there is a potential for crowding. And by the way, there are now low cost, ETF versions of these smart beta factors, let's say. So you got to say, look, some of the efficacy of that those anomalies, right? They may persist. And if they're really cheaply available, that efficacy goes down. But it's interesting because what it doesn't mean is that there's no value in using those types of factors. They're there. And I referenced kind of behavioral finance as part of kind of at least my own personal thinking. They're there in many cases because there's a persistent reason that those factors tend to drive returns. And sure, broadly, right? To a large extent, markets are pretty darn efficient, but I always like to remind people that they're only efficient because we're all constantly working to keep them efficient. And to any extent that anybody does not do that, these effects will persist. So the way that we think about those kind of traditional factor category families is not to stay away from them, but rather to look for ways to customize and make proprietary versions. So when we say factors zoo, what we don't love is like a real humongous proliferation of lots of different things that don't have an economic rationale, or kind of really going into a data mining space. But what we are going to do is look within those kind of traditional categories and do a continuous research process where we're looking for, okay, is there a twist on that? Okay, what's the time scale over which we're going to look at that? A lot of these factors, you can think about levels and changes in levels. You can think about, what group am I normalizing this against, right? Who am I ranking against? How am I clustering that? How am I thinking about that, incorporating that signal with the other signals in my model? So that's one thing I would say, is that we do not, with the enhanced products that I oversee, we do not stay away from those categories. We try to find the best, most proprietary, individualized versions of implementation within those categories, because we believe there's value on the table, and premia effectively to be harvested. Okay, so I would say that. The other thing I would say is that certainly the other big trend, and humbling in quant, right, has been the value cycle of these sort of traditional valuation metrics and measures that were very favored by quants. I think, in the earlier part of the cycle, they just haven't worked, right, and they haven't worked for a long, long time as well as they did in further back history. That was sort of another common knock on quant, right? Is, hey, value's out of favor, so like quants can't figure anything else out. So what I think, has been a trend, but certainly, the research team that supports our group has worked on a ton, is to say, great, what else? So not that we're going to take value off the table, because by the way, it's a good diversifier to have, and there's a reason to have it in there. But what else? So we've done a lot of work. I would say, especially the team has in the last 10 years, trying to look at these non-traditional, we would call them returns drivers. So what I mean by non-traditional really is starting from a data source that is not price, volume, or a fundamentally derived field, but it could still be a fundamentally derived concept. So, an example that we've talked about publicly, because it's, I think, pretty well talked about, but still a good example would be, hey, I might have, analyst information that's tabular available to me. I know what all the analysts are thinking about, where earnings are going to come in. Then I get a report. I know where the earnings are coming in. Okay, great. That's traditional information. Now, hey, can I text mine the transcript of the earnings call? And can I look for additional information in that? A lot of people do that, but it's just a good example of, what do you mean by non-traditional? We're not looking at phases of the moon. Okay. We're not looking like at really wacky things. We're just trying to find additional, data sources that are going to maybe speak to those same fundamental returns drivers. And then that's an area where, when you are looking, and certainly it's something that, a lot of quants are doing, but when you are trying to look at other types of and sources of data, like that can also be news, right? It can also be social media. It can be credit card receipts. There's endless sources you can kind of go look at. The cool thing about that whole area is you're continuing to see, with the advent of new computer science based tools. So, be they machine learning techniques, anything that's like another fancy version of pattern recognition, which LLMs are kind of like another fancy version of pattern recognition. What's kind of cool there is you can say, okay, I already kind of had the idea. I had a simple implementation of that idea. I can now try these new tools, and I now can look and say, is this more sophisticated tool better at getting at, where the sentiment of, the folks asking questions on the earnings call, right? Where's the sentiment of the folks speaking on behalf of the company and there? And so that's kind of a nice spot for quants. We like to find places where we can have a ground truth and then incrementally improve a prediction over time. So that non-traditional bucket has been a really interesting category for us. And then what we do is we tend to take this, underlying alpha model that drives a lot of our strategies. We're constantly improving it and adding new information to it, but on a little bit of a lower frequency cycle, we're retraining, we call that sort of whole model, and thinking about how to calibrate those weights. That's happening on a pretty like lower frequency time scale, I would say. But what it does do is over time, less weight will go to returns drivers that aren't working as well, and more weight will go to returns drivers that are. So if you were to go and look at, if I were to let you go peek in the inner workings of our model and go back through that 10 years, you'd see reweightings happening within these returns drivers, both due to underperformance, but also due to adding a lot more non-value based signals. You're just going to reduce the exposure to those value signals. And then look, as over time, if there's, a resurgence, these aren't the kind of models that are going to catch things on a dime pivoting. But over time, if you've got things coming back in favor, that were at one point out of favor, you will start to see those come back in. So that kind of slower moving recalibration is something that we have found is a nice balanced way to try to, again, have a little bit of that trade-off of, we do know markets change through time. It's difficult to predict in what way that's happening, and it's difficult to know over what time scale to say, yeah, things are different, go forward, versus this is a transient hiccup. That's I think a big challenge that a lot of market participants are always trying to solve.
A couple of questions there. First is you'd mentioned that, and I would very much agree, markets are very largely efficient because of our presence in them. We're making them efficient. Um, and, you would think that a source of excess return, sources of excess return, there might be some persistence there, but they can't get too big, or else markets will adjust them, right? The competitive process will reduce that anticipated return via price. I'm wondering, as you sort of look at the evolution of factor returns, and maybe we'll treat value a little separately, but what have you seen in terms of market competition, those forces, and then the returns to factors over time? Have you seen them erode, and are there kind of specific examples as you've watched as time has progressed where a really, really good deal in terms of excess return
Oh yeah.
became less a good deal?
So I think what's what's interesting, and I want to talk about that, is what's really interesting to me usually is like, well, what's going to be the same in 10 years that was the same 10 years ago? And these really broad categories, like, you can't kill them. So there's a reason we continue to talk about these categories. So I don't think they go away. But I do think that if you get now more granular, or certainly if you get to things that are like very juicy, like someone finds an arbitrage, okay, a real arbitrage, that goes away, right? A real true arbitrage, like it goes away quick, right? Let's take an example. Basically, what do we know market makers do, right? Like, they're all the time in there looking at, okay, here's an ETF, here's an index, here's how I think that, right? And they're constantly like, that's how they're making their money, right? So we know that that's going away on a really, really short time scale. So I think that when you go granular into either true arbitrage opportunities, or maybe kind of these, like, okay, here's a good example. If I and I don't have like numbers on this, but I'll say, like, here's what I kind of generally think. When there was first an ability to get access to sort of like credit card data, okay, it was really expensive, right? And only a few firms on the street were buying it at first, let's say at that time. Do I believe that and by the way, you never exactly know, because you don't know what everybody else is making money on. By the time you know everybody else is making money on it, like, you figured that out, maybe it's been armed away. But I think this one, maybe folks would agree with me that in sort of an initial period, the amount you could get off of a factor you thought of a smart way to get at that you knew about credit card receipt data, like I think that erodes, right? Pretty, I don't know how quickly, but I think that data is much more broadly available today than it was when it first came out. And so, a factor that I might have designed around that data, 15 years ago, it's probably not going to be efficacious anymore. But does that mean that the broad value of being able to predict next quarter's earnings, if that's not valuable anymore? No, that thing is still valuable. It's just that now I got to find another way to try to do that better. So like that's what I think is sort of the trade-offs, is that like you can't ever get rid of that new information is released to the market, there will be a price response, right? So that's where a lot of the arms race comes in, is how do I get other nowcasting information that might allow me to have a better estimate of what that new information when it's revealed is going to be. But it's always going to, like, new information being revealed is always going to move prices. So to me, it's sort of like that's where there's a little bit of an idea of an arms race, that I think it gets the things being transient and going away. It becomes like the really specific implementation, not the sort of broad concept, is not valuable anymore.
I'd love to learn a little bit more about these non-traditional, call them factors or pieces of data, data sets. You kind of mentioned the credit card data was all the rage, but that's likely been arbed away, so to speak. But we're constantly doing two things. One is we're generating new data sets, and then, as you referenced earlier, the power of LLMs and things like what is it called, NLPs, right? The just language, reading language and transcripts. Um, Talk to us a little bit about the non-traditional factors and how your team are both finding them, testing them, and then seeing how they can be incorporated.
Yeah. So, what I'd love to do here, since we do kind of view that non traditional category as, probably most proprietary, what I'm going to do is sort of zoom out and speak in what I'll say are more generalities that are, not hyper specific to exactly, obviously, kind of what proprietary components we're using. But I think I can give you a flavor that's still more kind of what you're asking for in general. Like, what are these types of things, and how do they work? So, like, I guess what I would say just on that text piece, is the evolution has gone something like this. So maybe initially I would have the technology to scan a whole bunch of text and pull out numbers, right? And so I could sort of go from a lot of text, to reducing that down to like a ticker and a field I was looking for and a number. Okay, so there's like a really simple way of almost turning a whole bunch of text into a table, right? And then now I've reduced it from, we would call like a big body of text, like a non-normalized data set. And I could turn that into quote unquote a normalized data set. So that would mean what we quants like to do is get the same kind of information about every single stock in our investable universe on every single day. Okay. So that would look, right, like a big table that says, okay, stock ticker by date by whatever number I want to extract about it. So if that's been around a long, long time, from there, let's skip to these natural language processing, or sort of bag of words, is like a fun named one that got used a lot, right? So there I'm just going from saying, all right, I'm going to go scan for this one thing and try to hope there's a number next to it, right? Like EPS or whatever number I'm trying to grab. I'm going to go from that to, I'm going to look for a sentiment. That's a different thing than just extracting a number. Well, how do I get the sentiment? Okay, well, one of the first ways, this is not my area of way expertise, but I know just enough to be dangerous. Okay, so one of the ways you can extract sentiment, just think about it. It's like, get a list of words that you as a human have curated as being good, positive, a sentiment associated, like fantastic, great, upside surprise, right? What have you? Maybe upside surprise is actually two words, but you can still put them both in there, right? So that's a thing that people did a lot of initially. Was, I said, let's get human curated, right? And by the way, that is where like a lot of these innovations come. At some point, a human is labeling, curating, or giving input. Okay, that is an important step. And I think it's important to keep in mind that even the most systematic quantity approach, we're trying to take what people can do and scale it, right? And do it faster and better. It's not magic, right? It's trying to automate and scale and normalize insights to basically be able to create edge. So, okay, you'd label all these words and then you would have that word list of words and you go have the computer look for them. So that would be this bag of words style approach. Okay, it's good. That's better, right? That's better maybe than just a number because now I've got something that says here's a 1 to 10 score of a sentiment of that piece of text. We'll now skip ahead to LLM world. And we can all see how this stuff works. So you've got a really sophisticated model that cannot just guess at the sentiment based on creating a histogram of word counts. You can actually have extracted the contextual information, kind of like a person would be able to read and understand. It's pretty cool, honestly. And I will say we've done so just sort of at a high level. My team and others inside Fidelity, and I know that everywhere on the street, everybody is working on this. We've done a lot of looking at how powerful are those LLMs, and if you've got the right kind of data, they're really really good. We can all see that, right? You can see that yourself when you go log in and noodle around with some of these models that are available. So we see a lot of exciting ways to utilize that information, but that would sort of be a broad category that I would speak of non-traditional. Now, like you said, look, there's lots of other types of data that are out there. One thing I'll say maybe that is where it's a little bit like less useful for my team and maybe more useful for folks that are looking from a more fundamental lens. So maybe that's interesting. If you are caring not about like, okay, I got to care about where can I find similar type of information that's available across a lot of companies, like ideally most of my investable universe. And ideally, I want history. So I'm looking for these types of data for which they're available and broadly consistent. I can normalize across like every company in my investment universe. And ideally, I want that data to have been kept track of for like hopefully a long time. Okay, that rules out a lot of interesting data sets that might just apply to a small number of companies and might have only been available recently for a short period of time. So if you get into these really more edge casey data sets, I would say then those are really more relevant if I'm not a quant trying to rank every single stock in the universe, but if I'm just looking as maybe a fundamental investor or a retail investor, just want to develop an opinion of do I like this one company versus what it's currently trading at. Some of those niche data sets lend themselves better to more single stock analysis and have been more difficult for us to use in what I would call it cross-sectional quant analysis. So that's a place where maybe there's that's kind of where we have not had as much success. And but I'll tell you, that is an area quants have really wanted to crack for a long time. And what folks do try to do, just broadly speaking, is and it's hard to do. I don't know how well it works. Maybe you have audience members that do this. You say, okay, well, I can't really normalize everything. So I'm going to try to create like lots of little models that just score a handful of stocks. And then I'm going to try to composite those back together. That's tough. So we don't tend to do as much of that. We're really looking at where are there factors, traditional or not, right? Wherever I'm getting the data, we are looking for where I've got good data coverage across all the stocks in my universe and where I've got some historical consistency so I can develop confidence that, this relationship I see today in the data was consistent across, hopefully if I can have some kind of full market cycle, but as long of history as I can have.
Well, let's finish the conversation here. We've been talking about how quants like you are using this powerful new tool called an LLM. I mean, it really is incredible what some of these models can do. So you're using it in your investment process, but it's so interesting that the global benchmark of the world, the S&P, is dominated by this. I won't call it a factor, but it would be hard not to say that the S&P is epically concentrated in the Mag 7. 30 odd percent in the top 7 stocks. It is a awfully top heavy index. And so this is where I'd love to finish it off, which is you've got benchmarks. You are constrained to try to achieve alpha around those benchmarks. I'm sure the S&P makes its way into the conversation. How is investing in this particular climate, given quant investing at Fidelity? What does it look like in the context of an S&P that's just got so much riding on it, in terms of its top heaviness and its Mag 7 top heaviness?
Yeah, no, it's really interesting. And, like you highlighted, it's a great place to be to have a suite of strategies that utilize the same kind of approach in lots of different investable universes. Okay. So that allows us, we obviously care about, right, that those concentrated universes. It's nice to be able to see those and our model's ability to succeed in those concentrated universes within a bit of a broader context to kind of keep some perspective. Okay. But yeah, I think, broadly, the more concentrated any investable universe gets, the more difficult it is to create opportunities, breadth for dispersion or differentiated investments, right? That's as true for quants as it is true for anyone, I think. So what I think we see is, what are we versus our peers doing in different benchmark relative markets? We are running really tight risk managed products. Okay. So what that's going to mean is that in some markets, we're going to have a headwind due to that. And in some markets, we're going to have a tailwind. Some benchmarks, we're going to have a tailwind due to that. We really don't have you know, a view that we put into our products on how long that concentration is going to persist, and when and what may happen. Um, you know, that said, I think what generally I would describe it as is it's constraining the opportunity set. I would say. And I think anybody would say that. So I guess what we've seen as a result of that is that, and this is not to make any kind of endorsement or forward-looking view, but just to observe broadly, that I think investors are aware of this concentration. They're certainly aware of trailing returns, and for a long time, I do think that drives a lot of piling in. I do think I'm not saying I've seen any signs of necessarily any panic or anything like that. But what I do see is people starting to ask us and others, "Hey, do you have an equal weighted benchmark product out there?" Which at first, by the way, I'll tell you, like, when people were first asking me about this, I would hear it in conversation. I was like, "Who wants an equal weighted benchmark? Like, the benchmark is the benchmark. Like, tough luck, basically, right?" And now it's asked about a lot, and I think people are talking more about that. And the other thing I've observed is, look, think about how we would talk about the like U.S. tech market versus international markets like 5 years ago versus how we might be talking about it today and where you're seeing flows going. So to me, I think we try to keep our eye on that and to continue to watch all our investment mandates and, 525 rule, right? Concentration rules. A lot of the products that we oversee are required to be diversified. Some products that we oversee have an exemptive relief from that diversification. So, we're looking at that closely. But I guess the way that we invest, that is really more of sort of like we've spoken about, kind of like a broad concentration risk that we're aware of and looking to manage around. And I don't see it particularly as it's in and of itself presenting a great opportunity for stock selection. Right. So I think the game is about trying to have a very broad lens and see where you can look for stock selection edge. Right. And I think that quants broadly are doing a lot of looking outside of the US. That's kind of been a general trend for a long time that when you get away from, large caps and when you get ex US, of course, you've got, a little bit of a different playing field in terms of maybe who the peer set is. Now, I think that continues to get obviously competitive, but you also at least have more breadth, right? I mean, if you're looking at sort of what's the, sort of average cross-sectional correlation, if everything goes to one, it doesn't matter what you pick, right? Or if basically like a small subset of the universe becomes completely representative of where the overall benchmark goes, it's a lot harder to add value. So I think it's okay recognizing that, doing the best that you can for your investor in that spot, because a lot of people need to own, those markets, and then really saying, okay, great, and are we finding every edge and advantage we can for investors that are able to look, outside of that concentrated space.
Well, I like the approach. I've often said the S&P is the best benchmark the world has ever seen. It's tough to beat, but so it's a great starting point. And maybe the approach is like yours, which is try to add alpha at the edges. I think that's and doing it systematically. Jess, it's been a pleasure to learn a little bit more about what you and your team do and about your investment process. So thank you for being a guest on the Alpha Exchange.
I really enjoyed it, Dean. Thank you for having me.